If you have just witnessed Bitcoin plunging, while BlackRock continues to offload an additional $175 million via ETFs, there is a high likelihood that you are observing the market from the wrong structural layer. Not because you lack information, but because at this point, price is no longer a reflection of conviction or panic. It is a reflection of positions that are structurally compelled to be closed. If you are holding US dollars, foreign currencies, gold, silver, or simply standing in front of a screen asking why everything is unfolding with such speed, the relevant question is not where price is heading, but which behavioral function of the system you are being drawn into. When the market opens, the dominant sensation is not fear, but velocity. Prices do not drift downward incrementally. They descend in discrete steps, with each update representing a materially different level. If you were watching the screen at that moment, there was no opportunity to consider what information had just emerged. There was no information, no statements, no policy announcements, only price panels changing color in rapid succession, dense, uninterrupted, resembling a sequence of actions that had already been mechanically activated. It is precisely at this juncture that many participants conflate "the market is selling" with "the market is being forced to sell." This distinction is nearly invisible if one's observation stops at price alone. But a deeper examination reveals an anomaly. Trading volume expands sharply at the exact point where prices are declining most violently. This is not an emotional response. It is the signature of a mechanism executing its function. When BlackRock continues to sell another $175 million worth of Bitcoin through ETFs, that activity does not occur in isolation. It unfolds within a very specific macro-financial environment: a strengthening US dollar, elevated capital costs, tightening global liquidity, and risk management protocols taking precedence over any long-term narrative. Under these conditions, ETFs cease to function as a bridge between institutional capital and Bitcoin. They become pressure release mechanisms. For anyone familiar with portfolio rebalancing in traditional markets, this pattern is immediately recognizable. There is no emotion, no debate, only execution. Once a risk threshold is breached, the system does not inquire about expectations or future beliefs. It asks only one operational question: how many positions must be reduced immediately? This is the moment when many observers begin to feel that the market is unfair. But markets do not operate on fairness. They operate on liquidity. And Bitcoin, via ETF structures, currently represents one of the most efficient instruments available for rapid risk reduction. This dynamic is inseparable from the role of the US dollar. During periods of fiscal and monetary stress, the dollar is not merely a unit of account. It becomes the primary destination of capital. When liquidity retreats toward the dollar, all other assets are subjected to the same imperative: which assets can be liquidated first to obtain cash? Assets with deep markets, continuous turnover, and well-defined legal infrastructure are invariably prioritized. Bitcoin now resides within that category. If it feels paradoxical to observe sharp price declines alongside relatively stable long-term holding data, that perception is not misguided. It accurately reflects market stratification. One layer of participants is being compelled to act by risk management constraints. Another layer retains the capacity to observe without responding. This is where the analytical framework of this channel diverges from much of the prevailing commentary. Rather than asking who is manipulating the market, the more relevant inquiry is, what type of behavior is the system currently rewarding? In the present environment, the system rewards speed of risk reduction, not short-term expressions of long-term conviction. As a result, a phenomenon emerges that many viewers find unsettling. Positive developments appear, yet prices remain unresponsive. Announcements of accumulation, favorable narratives, even optimistic historical analogies fail to generate immediate price reactions. Not because they are incorrect, but because they do not address the constraint the system is actively resolving. This represents a critical inflection. When markets cease to respond to positive information, it is often interpreted as dysfunction. In reality, it signals a transition into a restructuring phase rather than a conventional price discovery phase. In such phases, narratives recede while mechanical processes dominate. For those who have observed gold and silver during previous periods of systemic stress, this configuration is familiar. Paper markets react swiftly, sometimes violently. Physical holding behavior responds slowly, if at all. This phase mismatch has historically generated controversy, yet it consistently emerges whenever liquidity becomes the overriding priority. Bitcoin is now entering this same intersection. It functions simultaneously as a perceived defensive asset and as a risk management instrument for institutions. When these roles conflict, volatility is unavoidable. At this stage, participants must confront a specific question. In what capacity are they engaging with the market? As actors responding to minute-by-minute price movements, or as observers attempting to understand capital behavior? There is no universally correct stance, but failing to distinguish between these roles increases the likelihood of being drawn into the operational tempo of a market Layer 1 does not belong to. This is the defining characteristic of this channel's perspective. It does not attempt to persuade viewers that the market is inherently good or bad. It does not construct deterministic forecasts. Instead, it situates the viewer within the present reality, a system operating according to its own internal logic, often impersonal, occasionally uncomfortable, but fundamentally non-random. When the sequence of events is viewed in its entirety, ETF capital flows, the gravitational role of the US dollar, muted price responses to positive signals, and the behavioral segmentation of participants, a coherent structure becomes visible. No conspiracy framework is required to recognize that this is not a routine episode of volatility. Nor is it necessary to assume premeditated design. What matters most in this phase is not accurately predicting the next directional move, but understanding the nature of what is unfolding. Understanding prevents overreaction to price movement. Understanding prevents responses from the wrong structural layer. Understanding preserves clarity in an environment where speed consistently outpaces emotion. Whether you are observing the market through US dollars, foreign currencies, gold, silver, or Bitcoin, this is not merely a narrative about a single asset. It is an illustration of how the modern financial system processes stress. And it is precisely in such moments that the distinction between reactive participants and observational participants becomes most apparent. What do you perceive when you look at the market now? A price collapse or a system undergoing internal adjustment? That perception reveals far more about your position within the system than about the asset itself. Share how you are interpreting this moment, not to determine winners or losers, but to deepen collective understanding of the reality we are navigating. This is why the current episode cannot be reduced to a simple price decline. It is a moment in which the market is compelled to expose its underlying structure: liquidity constraints tightening, monetary policy exerting directional force, and modern financial instruments such as ETFs reflecting not belief but risk discipline. Under these conditions, the primary question is not where will price go, but rather who is being forced to act, and who retains the ability not to. Placed within the broader arc of monetary history, this process is entirely familiar. Every period of stress reasserts the function of defensive assets. Gold and silver have fulfilled this role before, quietly, without promises of rapid returns, yet preserving purchasing power as systems recalibrate. Bitcoin is now being tested within the same framework, not as a technological narrative, but as a component of a long-duration monetary cycle. And this may represent only the opening phase. Shifts in policy orientation, capital allocation, and institutional risk governance are likely to persist in the quarters ahead. The question that remains is how the functional role of each asset will be redefined once the short-term dislocation subsides. How do you believe this will affect the US dollar, gold, silver, and other defensive assets going forward? Share your perspective. This is Money Cycles, where the focus is not on headlines, but on the structural mechanics of cycles themselves. And often, the most important outcome is not being right about the future, but understanding the moment one is currently inhabiting.